new jobs and halting inflation. We must protect the position of the American dollar as a pillar of monetary stability around the world. In the past 7 years, there's been an average of one international monetary crisis every year. Now, who gains from these crises? Not the working man, not the investor, not the real producers of wealth. The gainers are the international money speculators. Because they thrive on crises, they help to create them. In recent weeks, the speculators have been waging an all-out war on the American dollar. The strength of a nation's currency is based on the strength of that nation's economy. And the American economy is by far the strongest in the world. Accordingly, I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States. Now, what is this action, which is very technical, what does it mean for you? Let me lay to rest the bugaboo of what is called devaluation. If you want to buy a foreign car or take a trip abroad, market conditions may cause your dollar to buy slightly less. But if you are among the overwhelming majority of Americans who buy American-made products in America, your dollar will be worth just as much tomorrow as it is today. The effect of this action, in other words, will be to stabilize the dollar. Now, this action will not win us any friends among the international money traders. But our primary concern is with the American workers and with fair competition around the world. To our friends abroad, including the many responsible members of the international banking community who are dedicated to stability in the flow of trade, I give this assurance. The United States has always been and will continue to be a forward-looking and trustworthy trading partner. In full cooperation with the International Monetary Fund and those who trade with us, we will press for the necessary reforms to set up an urgently needed new international monetary system. Stability and equal treatment is in everybody's best interest. I am determined that the American dollar must never again be a hostage in the hands of international speculators. I'm taking one further step to protect the dollar, to improve our balance of payments, and to increase jobs for Americans. As a temporary measure, I am today imposing an additional tax of 10% on goods imported into the United States. This is a better solution for international trade than direct controls on the amount of imports. This import tax is a temporary action. It isn't directed against any other country. It's an action to make certain that American products will not be at a disadvantage because of unfair exchange rates. When the unfair treatment is ended, the import tax will end as well. As a result of these actions, the product of American labor will be more competitive, and the unfair edge that some of our foreign competition has will be removed. This is a major reason why our trade balance has eroded over the past 15 years.
All right, how's it going, everybody? Welcome back to the show. It's time for another brand new episode of the Politics and Punk Rock Podcast. I am Andrew for America, and it is now September 2025, and the stock market has taken a bit of a tumble, and I saw a recent news report on Fox Business, I believe, that is a great way to introduce what we're going to be talking about on the show today. So let's start the show with this clip. And here we go. Take a listen to this.
Nicholas joining me now. David, September has a reputation for being the market's weakest month. Okay, fair enough. Why do you think the market is down so much today?
Well, I think this has a lot to do with interest rates. So I think the interest rates and gold are really correlated to what's happening right now, Stuart. So September's bad for the markets, but I don't know if this is going to be as bad as it's been historically. But this, to me, today's interest rate and debt-driven with central banks, a real warning to central banks around the world, Stuart.
What's this warning to central banks around the world? What's that? You mean the British and the French? They're having debt troubles of their own?
Well, the entire world is having debt troubles. This is what's interesting. The U.S. is kind of the last central bank here. Most central banks around the world have skyrocketing debt, but they're lowering interest rates with inflation still not fully under control globally. So I think this is the market and even gold saying, hey, I don't really know if we trust the central bank's ability to rein debt in, because here's the challenge here. So you see our debt levels. We still have a lot of spending. We've done a lot of good out of this administration. There's still a lot of deficit in debt spending. The market doesn't like that. And I think that's why you see interest rates heading higher this morning, Stuart.
Yeah, will they continue to head higher? And if they do, that is a big problem for the stock market. David, thanks for being with us. We'll see you again real soon.
Okay, so the markets are having I'm sorry, they're losing faith is what I meant to say. The headline for that news story was, the markets are losing faith in central banks. I've been talking about fiat currency and central banking and printing money out of nothing and rising inflation and the level of power and control this gives to international world banking cartels. Taking the money and the currency off of a gold standard. Printing monopoly funny money backed by nothing is an inevitable crisis waiting to happen. And a lot of pontificators have been saying for a while that another crisis is coming. Maybe a crash so bad that it'll make the Great Depression look like nothing. The entire world owes millions of dollars to who? Who do they owe the money to? If everybody owes money to the central banks, that means the central banks have ultimate total control. And that, in my opinion, is going to be the vehicle for CBDCs, destroying the dollar, cashless society, new world order, right? A lot of people say, oh, it's still conspiratorial, Andrew, for America, going doom and gloom on all the shit. But you know what, people? What do I always say to you? It's only a matter of time. You can't kick the can down the road and keep increasing the debt ceiling over and over again. Einstein's definition of insanity, doing the same thing over and over and over again and expecting a different result. It's the same thing with voting for Republicans and Democrats. If you keep doing the same thing over and over and over again and expecting a different result, you are insane. Today, my guest is a very intelligent gentleman. His name is Paul Musson. Paul Musson is the founder of Paddington Capital Management, and he's a former lead portfolio manager of the Ivy funds at Mackenzie Investments. I believe he's from Canada. And he pulls back the curtain on the financial system that quietly but powerfully shape our lives in his upcoming book, Capital, and this isn't upcoming anymore. His book has been released. His book is called Capital Offence, Why Some Benefit at Your expense. And Paul explains in plain spoken, relatable terms how central banks, government policy, and entrenched economic structures inadvertently, yet systematically, extract wealth from ordinary people while enriching a small, powerful elite. The system is working exactly as it was designed. I've been saying it. Many people have been saying it for years. Nothing has changed. The more you play the central banking game, the more the stuff is going to occur. Okay? Let's bring this in. Here we go. This is Paul Musson's page. There's his book right there, Capital Offence. Actually, let's click on this and let's take a look at it. Here we go. Here's his book, Capital Offence. You can go get it on Amazon, $24. Let's read the notes here. In Capital Offence, award-winning investor Paul Musson shows how the world is becoming increasingly divided on many fronts. One of the root causes of this is that well-intended policymakers have drunk the something from nothing Kool-Aid and are convinced that there is such a thing as a free lunch. There isn't. They believe that debt-fueled spending is what leads to economic prosperity. What a joke. I've been over this. It does not. The direct result of these central bank-supported policies is growing wealth disparity, where some people are able to extract more from our economic system than they create, while others are left to foot the bill. And you've heard this often, where big business socializes their externalities and then capitalizes on the gains, right? Most books on this subject speak in a language understood only by those steeped in financial jargon. But Paul Musson uses everyday language and analogies to help readers understand why the economy is moving in the wrong direction. The next generation is now poised to be worse off than its predecessors. Not because they are less productive, but because older generations are benefiting at their expense. An unsustainable and immoral reality. And who does that sound like? My fellow Americans. That sounds a lot like me. Paul Musson gives us steps for reform. And while the painful choices ahead are inevitable, facing them now will prevent even greater consequences later. Facing them now will prevent even greater consequences later. That reminds me of when I tell you, the more you run away from the truth, the more you are making matters worse. Right? Okay. So Mr. Paul Musson and I today have a great conversation about the government policy on money and markets, and how policymakers are ignorant to how finance actually works. And so long ago, those policymakers handed over control to the Fed and said, here, you guys know what you're doing, right? You be in charge of our money and our currency. And it's a privately owned company. The Fed is not an American government institution. It's not even an American business. It's a privately owned international banking cartel that are beholden to absolutely no one. That's a problem. When people who do not suffer any consequences for their actions are in control of anything, it doesn't matter how many mistakes they make, because they're fine. It's everybody else that lives under that control that takes the shaft. I've been trying to get you people, you good, fine American people, to understand this for a very long time. And I hope Mr. Paul Musson and my conversation today will help you understand. So, my fellow Americans, allow me to present to you, after this commercial break, episode 236 of the Politics and Punk Rock podcast, entitled Capital Offense, with Mr. Paul Musson. I'll be right back. All right, everybody, welcome back to the show. Today, he has spent 30 years in the investment industry, mainly focusing on portfolio management before taking the leap to start his own firm, Paddington Capital Management. Now he's channeling that extensive experience into exploring how economic systems impact the everyday person through his blog, Political Economy. And he has recently released a book, Capital Offence: Why Some Benefit at Your Expense. And he joins us here today. Paul Musson, sir, welcome to the show. Thanks for being here.
Well, thanks for having me, Andrew. This is great.
Yeah, I'm looking forward to this conversation. So yeah, give my audience just a little bit of background on you, and then let's talk about some of these talking points as far as fiat currency, like I mentioned in the pre-show, and how inflation is just robbing the average person's buying power. I think a lot of people that listen to my show are definitely going to be interested in hearing your expertise. So,
Excellent.
yeah, let's start with that. Give my audience a little bit of background on you.
Okay, a little bit of background. As you said, I've spent my career in the investment industry, mainly in portfolio management, investing in equities, global equities, so looking around the world for the best utilizers of capital, companies that would put my clients' hard-earned capital that they have saved. They've decided not to consume it. They've decided to save it for their retirement. They give it to me and my team. We look around the world for the businesses that will put it to the most productive use, will provide the best customer value proposition, so people want to buy that product, and the profit goes up. The company can hire more employees. They can pay them more. The share price rises. Our clients make money. We make money. That's the way it's supposed to work. It's a beautiful thing. Nobody's making money at anybody else's expense. Now, so I was doing that I was at Mackenzie Investments most of my career. Great company. And I love my job. And I love pretty much every aspect of it, to be honest. But over the years, I got increasingly frustrated watching how central banks were distorting the price discovery mechanism of markets for short-term gain and ignoring the second and third order knock-on effect consequences of those actions. And we will get into it. Essentially, what they were doing, and are doing to this day, they're sacrificing the Main Street economy on the altar of higher asset prices, both stocks and houses. And over the years, I was frustrated and angry about this, even pre-Great Financial Crisis, and of course with the Ben Bernanke's response to it, I was even angrier. And so for years, people always said, "Oh, don't bring up central banks when Paul's in the room because I go wild." But my method of communication, what I learned over the years was to stop trying to impress people, and it's very intellectually dishonest. I was younger, I would try and impress them with how smart I was and how much I knew. And that if they knew, or if they not knew, if they believed that I was smart, they'd give me their money.
Sure.
So we could manage it, would make money that way. But then you get caught up in little white lies along the way, it's really embarrassing and it's just wrong. And so I just said, I'm going to be brutally honest with people about what I do, why, what to expect, when you'll do well with us and when you won't. and put all that information into the hands of our clients because they're smart people and they're adults and they can make the right decisions. They don't need me to make the decision for them.
Sure.
I just give them the straight bill of goods. Now they decide whether or not I'm right for their client. So I used to talk straight like this about what was going on in the world, how they're getting ripped off. And then over the years, more and more were saying, Paul, you should write a book about this. And communication became my great passion. And so that's what I did. And I started writing my book in 2019, so a long time ago. But when you're working full time, you can't write a book like in the evenings, or well, I couldn't anyways, or on the weekends. You need large blocks of time. So it was only on vacations. And so I was just getting frustrated not being able to finish the book. So I decided to leave Mackenzie Investments back in 2023 so I could finish my book. And I'd already started my free blog, which is called Political Economy, Paul. And again, it's all about just empowering people with truth, with understanding. Because I do believe that the average person is very smart, particularly when it comes to what to do with their own hard-earned capital, how much of it to spend, how much of it to save, and what price to pay. They don't need policymakers telling them how much they should spend and, oh, you should be buying that even though you think it's overpriced. No, let the people make their own decisions. So by empowering people with knowledge and truth, my hope is that we can change things for the better. And so that's how I ended up here where I am.
I love that. That's awesome. One of the things that stood out to me when I was looking over your book was Rudy Havenstein on the back says, quote, "In the spirit of Henry Hazlitt, Musson's cogent prose should help those struggling to understand why the American dream seems to be slipping away. Highly recommended." As soon as I read that, I already knew you are familiar with the difference between a gold standard, gold-backed currency versus fiat currency. I knew you were familiar with Austrian versus Keynesian economics because a lot of people don't even know who Henry Hazlitt is. So, and then my audience knows that long time ago, one of my most listened to episodes was entitled Tragedy and Hope, where I was reading excerpts from Georgetown professor Carol Quigley's book, Tragedy and Hope, where he flat out says that there was a small group of financial elites that desired to create a system where they could create money out of nothing, where they could loan endless amounts of money, put everybody in debt, and have everybody be at their behest in the future because nobody could pay these structural adjustment loans off that we talked all these countries and governments around the world into taking so that we could come in and move our businesses in and effectively take the country's natural resources. So I know John Perkins, who wrote the book Confessions of an Economic Hitman, talks about this all the time. And so I wanted to get your opinion on creating money out of nothing. Give my audience a little bit of backstory from your perspective on first of all, why Nixon took us off the gold standard in 1971 and what that meant for the future of war and for the future of investing and saving now under this non-gold backed currency. What would you say to that?
Well, that's a pretty big question.
I know, kind of big.
So as you know, 1944, coming out of the Second World War, the Bretton Woods system was established.
Oh yeah.
In Bretton Woods, New Hampshire. And there was a real battle going on between the US and the UK with respect to what sort of system we would have. John Maynard Keynes was the one leading the negotiations on behalf of the UK. And the US won out mainly because it was by far the greatest economic power and the greatest military power. I mean, you might argue that the Soviet Union was pretty close at that time.
Sure.
But, that sort of carried the day. And so you had a world that was now on a U.S. reserve system where the U.S. was really the only country that could increase the money supply. And that's exactly what they did.
Yep.
And so through the 50s and and particularly started to accelerate during the 60s. And so whenever they would print money or increase the money supply, they're exporting dollars and creating inflation in other countries. And so back then, they, as you know, Roosevelt, he severed the link with gold for consumers back in 1933. Mm-hmm. You had to hand in all your gold, otherwise you could potentially face a $10,000 fine or 10 years in jail. But central banks of other countries could still convert their US dollars into gold. And so as the US was more and more increasing the money supply in the late 60s and then into the early 70s, other countries, they started to get nervous about, the value of the treasuries that they were holding in US dollars. And essentially they're being financially repressed. And so central banks around the world started handing in their US dollars and demanding gold because up to this day, central banks can't print gold.
Yep.
And so the gold reserves were running down, and they were, and I can't remember exactly what the numbers were, but I think they were already under the amount of gold reserves that we're supposed to have to back the currency. And so, and people will say that Nixon had no choice but to pull the plug on the gold standard.
Sure.
But the only reason he had no choice was because the U.S. decided to expand the money supply rapidly. If they hadn't done that, they wouldn't have had to close the gold window.
Sure. It almost enticed people to start calling in their pound of flesh and gold that they were owed. And we know that there's no way that any bank holds that much on hand. And I know Quigley talks about that in Tragedy and Hope a lot, about how they over time, bankers realized that only certain amounts of deposits and withdrawals were happening over time. So they realized they didn't need to carry all of the assets at one time. They just had to carry the percentage of what was being transferred between deposits and withdrawals. And Correct. So that's what created this idea of paper notes versus, you're not going to carry all your gold around with actual gold because it's heavy and cumbersome. You're not going to, and it's not easily tradable. So, yeah.
No, exactly. And so you had back in the day, obviously fractional reserve banking has been around for a while, and you had fractional reserve banking with a gold standard.
Sure.
And for most of the time, it worked well. And if you ever want to read, like, big fans of fractional reserve banking, and they're really good. George Selgin, I don't know if you've ever heard of him.
Heard the name, yeah.
Yeah, he just released a book called False Dawn, and it's about the New Deals during the Great Depression and what they did well and what they did not do well.
Ooh.
And it's a great read. And he's written it because there's a lot of myth about what the New Deal was all about. And he calls them 3 R's, and we're getting sidetracked here, but 3 R's of the New Deals. There was recovery, reform, and relief. So in terms of reform, that's when you got the SEC and FDIC, and you can argue whether or not FDIC is a good thing or not. And recovery. So reform, relief, and recovery. So in terms of reform and relief, the New Deals were successful in what they set out to achieve. But in terms of recovery, it was decidedly not. And you only have to look at how long the Depression lasted while these New Deals were going on. Now, correlation isn't always causation, but you might stop and pause and think, well, maybe one of these things has got something to do with the other.
Sure.
And anyway, so yes, you can have, fractional reserve bank has been around for a long time, and for most of the time, it worked well. On the other side of the coin, on the other side of the argument, you could look at Bob Murphy. He's an Austrian school economist, and I highly recommend reading his stuff as well. And I cite in my book a debate, a YouTube debate between George Selgin and Bob Murphy.
Ooh, nice.
On fractional reserve banking. So I'd encourage your listeners to listen to that. Both these guys are fantastic. They're on the opposite side of the fence on this particular issue.
Oh, perfect. I'll definitely want to listen to that. Yep.
But you'll learn a lot, by listening to these guys for sure.
That's awesome. So yeah, that's a little bit. I know my audience knows I'm redundant talking about tragedy and hope and creating money out of nothing, but Let's fast forward and talk about the stuff you talk about from your book. And let's talk about a major issue that I believe is happening today that, just like you said back in the day, is starting to create some tense, worried situations as far as the inflation and the money. Nowadays, I know groceries, the price tag at the grocery store is a big signal, I think, to a lot of people that something is going on, and people are blaming inflation all the time. And I saw that one of your talking points was, what real inflation adjusted wealth looks like for middle class families today, especially not only with grocery stores, but like everyone talks about Larry Fink and BlackRock, and how if the housing market tanks again, people are scared that these big funds and these big, BlackRock, Blackstone, whatever, are going to swoop in and gobble up all the single family houses, making it effectively more difficult for people to enjoy home ownership in this country, on top of everything else. So, from your expertise, can you get into that a little bit? What's happening, and how can people, help themselves or hedge in some way?
Yeah. So, it's a big problem. Now, first of all, with inflation, as it's a lot higher than the government authorities or bureaucrats will tell you that it is.
Absolutely.
And they use things like substitution or hedonic adjustments to lower the actual reported inflation rate. And hedonic adjustments simply are, if you have a car, let's say it's a Honda Civic, and next year it comes out and it's 10% more expensive. The government will look at the quality of that car, and if they think it's the quality is 10% better than the previous year, they will say you're getting that much more car for 10% more of your money, so the price didn't really go up.
Sure.
And I use the example in my book that from 1996, I think it was, to 2008, the average price of new cars in the U.S. went up like 50%, something like that, over 12 years. But because they were improving in quality, the government, in their CPI numbers, actually has the price falling. So they tell you that prices of cars have fallen over 12 years, but they're 50% higher. So, they've fallen, but I can't afford one anymore.
Yeah. Yeah.
And
people are saying, real quick, people are saying that about the stock market right now, that it's overinflated and it's all margin, and people, like, I've heard a lot of experts saying that people are starting to say sell everything, like, is another Great Depression type situation coming? So I don't know if that's speculation or.
Well, the markets are ridiculously expensive. And I was actually just writing about it in my blog this morning. You mentioned margin. So margin account balances are the highest in history right now. They cracked $1 trillion for the first time ever. Now, as a percentage of the market cap, they're still only around 1.6%. And it's usually once you get to like 2%, that, well, not usually, but often when you get to 2%, something bad can really happen. But that margin account, 1.6%, can look a lot lower if stocks are ridiculously expensive. So, if the numerator is crazy,
Yeah.
So, anyways,
it's a balancing act, it seems like.
or if the denominator, sorry. So anyways, so what we were talking about, was it, no, we're on from fractional reserve banking. Oh, inflation. And, maybe I'll just take a step back, Andrew, and, one of my main themes in the book is that most people, or many people, I should say, and it seems most politicians and policymakers don't know the difference between capital and money. And they're two very different things. Now, capital is all the things that people in the world are producing, either a product or a service. And so you are creating capital with your podcast, and people out there are consuming the capital that you are producing. And so the example I give is so we all produce capital, but then we use money to exchange that capital. So money is the medium of exchange. Money is very important, but you can have all the money in the world. If you got no capital, then, it's for nothing.
Sure.
So the example I give is that, you create capital. Let's say you make a bike, and I make a suit. So in a barter economy, it would be direct exchange, where you make a bike, I make a suit, and then we exchange the capital with each other. Before we made the bike and the suit, there was none of that in the economy. We both created it, so the economy is that much better off. And then we made an exchange, and it didn't come at the expense of anybody else.
Yep, both parties benefited.
Both
Absolutely.
parties benefit, and nobody else suffered.
Yep.
So that's fine, but you can't have a barter economy of any size. It just doesn't work. And so we have money as a medium of exchange, indirect exchange. So you make your bike. Let's say you make 10 bikes, and they're nice bikes, $1,000 each. You got $10,000. That $10,000, effectively, what that is your 10 bikes. You've got 10 bikes stored up in your $10,000. What gave that money value was the fact that you created capital, right? So you've got 10 bikes stored up in that $10,000. You put it in your bank account. But before you get a chance to spend your $10,000, I'll exaggerate here. So let's say the central bank doubles the money supply. Now, when the central bank creates money, it doesn't create any capital to get that money. It just creates the money out of thin air. So it's got no capital stored up in it, that new money. It only obtains capital when it comes into circulation by taking capital from the rest of the money that's already in circulation. So as soon as that doubling of the money supply gets into the economy, it extracts 5 of the bikes from your $10,000. So on your bank statement, it still says you've got $10,000, so you're feeling pretty good. But guess what? It contains only 5 bikes now instead of 10. And so now your $10,000 will only buy half as much as it would have done before the central bank doubled the money supply. And that's why my book is called Capital Offence, because every time they increase the money supply, they extract capital from everybody who's holding money, and they also diminish the purchasing power of your wages.
Yep. Yeah, very interesting and very confusing for a lot of people. And I love talking about this stuff with people that have been doing this for years like you, and just from my own research and knowledge, just to try to educate people, because like you said, it even goes up to the political level. I remember, I can't remember who I was listening to, but they were talking about how like you mentioned Ben Bernanke, and Alan Greenspan comes to mind, and anyone that's ever been the head of the Fed. There is, I've heard people say that there is this attitude amongst politicians that, they almost defer to the Fed because they aren't knowledgeable about how money and how things actually work. And if they were educated about it, maybe they would change their policy making decisions that would work in better ways for everybody. And the reason that they don't, and that they make more mistakes than solve problems, is because they are simply not aware and not knowledgeable, and they just defer to the Fed chair and whoever it is and then they just tell them how it is, which is, that's oligarchy and dictatorship in a ways, and from my perspective. So,
like they're not bad people. And
I'm not saying they're bad people. I'm just saying they're not knowledgeable, and people need the knowledge.
And I talk about this at length in my book. And bad environments bring out the worst in good people, and we're experiencing a hell of a lot of that these days.
Absolutely.
And but the problem with economics is that it's a social science like psychology. It's not a natural science like chemistry or physics. So there are a number of different economic schools of thought. And so some schools of thought, like Keynesian or whatever, which has been really bastardized over the years. Keynes wouldn't recognize what people call Keynesianism.
Sure.
And so politicians will lean towards those economists who tell them that deficits and debt don't matter. That yes, you should spend as much money as you can, take on debt, and don't worry, all the benefits of all your excessive deficit spending will trickle down. And as our prime minister said years ago, the budget will take care of itself, as if that's ever going to happen. And if spending was the fount of economic prosperity, my wife would be a gazillionaire by now, and she'd have left me years ago, And, what drives an economy is saving and investment. Consumption is the end game of all of this. but it's investment in saving that makes consumption possible, not consumption that makes saving and investment possible. And so policymakers will, they're politicians. They have to do what's popular. Otherwise, you're voted out of office. And so they've been making the wrong decisions for so many years, only because we demand it from them.
Sure.
Right. And so, one of the big issues is entitlement spending, which is just not affordable based on how much we're paying and how much we're taking in. So I think the latest number was, I think it's 2033 now or something like that, where Social Security is going to be insolvent unless changes are made. And it's because these systems are such that those who have been taking out, they take out more than they put in. Now, they've been changing it over the years, and with previous generations, it was even worse. And again, not bad intentions. Policymakers thought that, well, as long as populations continue to grow, you'll have more and more workers to fund the retirement of those who are older. And so those who are older can take more out of the system than they put in. And, the example, another example I use in the book is in France. Francois Mitterrand, who was president in 1983, he lowered the retirement age from 65 to 60. Of course, everybody loved him.
Yeah.
He got to retire 5 years earlier. Nothing bad happens to the economy, of course. No, the consequences are 20, 25, 30 years down the road. And now the cost of that is being thrust upon the next generation. The one I about sort of live my life where they sort of face the music, straight bill of goods approach. Sure. Try not to kid myself about anything. And the bottom line is that, if I'm getting something without contributing or earning it, then it's coming at somebody else's expense. Now, with government spending and central banks printing money, those who are benefiting and those who are paying, they're like 2 or 3 steps removed. So you can't make that direct causal relationship, and that's how they get away with it. And policymakers believe they're actually doing the right thing. I really do believe that. I don't believe it's a conspiracy. I believe that they think this is the right thing to do. It just happens to also be the popular thing to do. But it's tearing the world apart. And productivity growth has been grinding lower for decades. There's some bumps here and there. In the 90s with the dot-com, you had a bump. We may have a bump now coming with AI. But those bumps would have been even better and stronger if not for the rapid increase in the money supply.
Sure.
So it's because so many people they know they're getting screwed. They know prices are higher than government tells them it is. They know life is getting more difficult. They see a certain percentage of the population are making out like bandits. Wealth disparity has increased over the years. But they don't know why it's happening or how it's happening. And then it becomes, and this is just my opinion, then it becomes and you're looking for someone to blame. You're angry, you want to blame somebody. And so then it's very easy for Democrats to blame Republicans and Republicans to blame Democrats. And I know lots of people on both sides, beautiful people, right? But they're pitted against each other. Like we're creating like this, almost like a class struggle, and between generations as well. And in Canada, it's particularly bad for the next generation with our housing market. You think your housing market is nuts? You haven't seen anything. Ours is so, and Australia is really bad. And this is because this is a direct result of back in 01, 02, Alan Greenspan, Ben Bernanke joined the Fed, I think, in 2002. And coming out of that very, very narrow recession in 2001, it was only 1 quarter of contraction. It wasn't even the usual definition of a recession, which is 2 quarters of contraction. That Paul Krugman of the New York Times and Paul McCulley of PIMCO at the time, recommended, they were writing that the Fed should create another wealth effect because they just enjoyed a wealth effect of rising stock markets in that 99.com or 90s.com bubble. And then people were spending more. It's good for GDP. So they recommended, well, they should create another wealth effect, but do it through housing this time because more people own houses than stocks. So they take interest rates down to 1%. And kept them there for like 2 or 3 years, despite the fact that the economy was still growing. These were near historic low interest rates, and it was in a growing economy. Normally, these are like emergency. There's a war or a really bad recession or something like that. It was to drive asset prices higher. And so, as you know, became like a housing frenzy. And I don't know if you've ever read that book, The Big Short. Highly recommend.
Oh, yeah.
Sorry? Oh, you have? Yeah.
Oh, yeah.
And it didn't end well, obviously. And again, I've got 2 chapters on housing in my book. And, earlier we were saying that you should only be benefiting in a free market capitalist system to the extent that you've benefited somebody else.
Sure.
So, you made a bike, I made a suit, we exchanged it, we're both better off. So our house, we're in the suburbs of Toronto. And we bought it in 2001, so 24 years ago. If we sold it today, we would get 4 times what we paid for our house.
Yeah.
Now, what was our contribution to society to justify making 4 times on our home? It was 0. We didn't do anything. We just happened to be fortunate that we're older. And we bought just when these ridiculous central bank housing wealth effect policies started in 0102. And then Bank of Canada here followed suit. The Bank of England followed suit. The European Central Bank followed suit. And it was driving housing prices. And then QE came in after the GFC, driving asset prices higher and higher. And so if we're making 4 times on our home, but we didn't create any capital, it's still the same home. It's still the same capital that someone else has to pay 4 times for.
Yeah.
So then our benefit has to come at somebody else's expense. It's a redistribution of wealth within society. So when you're looking down on society, it's a redistribution of wealth from a younger couple or a newcomer to our country, from their bank account into our bank account. The capital stock didn't increase. Our house is not a productive asset. It's not producing 4 times as much stuff. It hasn't grown 4 times in size. It's the same economic good.
That makes sense.
And so younger people are screwed. The average house price in Canada from 1970 to 2000, so 30 years, the average house price to after-tax income ranged in a 6 to 8, range. So let's say 7 times. It's 12 times now.
It's insane.
It really is. And the younger generation are pissed, as they should be.
As they should be. I agree. Yeah, it's I hear people talk about that all the time. I see the memes going around social media, Gen Z people showing the numbers to the boomer generation that are like, oh, stop buying your $7 coffees from Starbucks and maybe you won't be in this situation. And then they show them the real numbers. It's like, no, your buying power was unbelievably larger and more effective than today. And and one of the things that I stand out to me, I was in San Diego during 2008 when the housing crisis happened. And I had a roommate that his parents owned a mortgage company. And I had another roommate who was working for Wells Fargo. And boy, did I get a crash course on something called a negative amortization loan. And when I learned how these were designed for people that were investors and trying to buy and flip homes, and you had people talking average every day, I want a 30-year fixed home. I'm moving my family and I'm laying down roots. I'm not ever going to move. And they got talked into these neg am loans to where they didn't realize 2 years into this loan, the amortization is going to strike and your monthly payment is going to be 3-4 times what it was. And they were unaware of that. And that was another, that's why I think it was Washington Mutual went down and some other, big. So So people hear that and then they just completely lose faith and trust in the system altogether. And it's tough to get that faith and trust back, especially when you see what's going on today. So what would, with all of this knowledge that, and this history and insight that we've been talking about so far, what are some solutions? How can we alleviate the pain for people? Or can they even? Is it all from the governmental Fed level that they have to make some big decisions, or is there anything that the average everyday person can do? What would you say to those people?
Well, unfortunately, there's no easy or painless way out of this.
Yeah,
that's going to affect.
True.
It's going to affect some more than others. If we do the right thing, it'll affect people negatively like me more than it will younger people, and younger people, I think, net will over time will benefit. But there's so much debt awash out there that trying to fix a system that is so leveraged, you're not going to be able to do it without some major hardship, unfortunately. But in the end of my book, I've got the 10 steps. It just happened to be 10. Whenever I see 10, I'm always suspicious. Like they just wanted to have a round number,
Right.
It just happened to come to 10. I thought of changing it, making it 9, but no, that was 10. And so step 1, well, I think the main thing we have to do is educate people, and including politicians, with respect to how an economy truly functions.
Sure.
And how wealth is created, and how that wealth should be fairly distributed. And so you and I distribute wealth with each other when we make a bike and a suit. And, there's nothing wrong with government within reason. And, if you're a wealthy economy, then it's a great thing to be able to have all these entitlement programs, to be able to help people who need help and for whatever reason weren't able to not work enough to save enough, or they're incapacitated, whatever. But again, within reason. Sure. You don't want to encourage people, incentivize people not to work.
Absolutely.
A great quote by Benjamin Anderson. He wrote extensively during the Great Depression. I think he worked for Chase. But he said, any country can have as much unemployment as they're willing to pay for. So if you're willing to boost the unemployment benefits, then you're going to have higher unemployment, and vice versa. But you want to help people who need help, that for sure. But so educating people that you can't get something for nothing. Somebody always pays. And then once you understand that, then I think people are much more willing to make the necessary decisions and steps to fix the system, even though they know it might be painful. And as long as they understand and believe that we will all be in this together, there's not me that's going to have to suffer, and all these other people, because nobody trusts the leadership anymore.
Right.
And so step 1 is really just stop increasing the money supply, and that is one of the most important. And if you stop increasing the money supply, then there's absolutely nothing wrong with a fiat system, with a fiat money system.
Sure.
The only thing wrong with it is that you can increase the money supply willy-nilly with the touch of a button.
Yeah. But just like you said, you can't rely on it like you can't rely on that being the standard operating procedure, just like you were saying previously. Like that can't be within, you said within reason. Anything, a welfare state, within reason. Yes, increase the money supply within reason, right?
Within reason. And, I think it was Milton Friedman. I think he advocated for more of a mechanical, I think 3 to 5% annual increase in the money supply. And that's it. Now it's grown much faster than that, obviously, over the last number of decades. But, if you look back at the late 1800s, so 1867 to 1897, so that 30-year period, the money supply only increased at just over 4% per year. But the productive capacity of the U.S. economy exploded higher. So the amount of stuff being produced was growing much faster than the money supply. And so you had 30 years of good deflation, slowly falling prices. And that's the way the economy is supposed to work. So when companies reinvest in their business, innovation, R&D to make things, to reduce their production costs, then their profitability increases. That attracts competition. More capital comes in. And so now that incumbent has to lower their price because of the competition, and it goes to the benefit of the consumer. So even if you're on a flat wage, every year you're getting wealthier because the money supply is not increasing too quickly, and we can all benefit from this innovation and investment that's going on. That's the way it's supposed to work.
Yeah.
But for the God knows how many decades, the money supply always grows faster than the amount of stuff, and that's why you have inflation. That's why prices continuously go up. So that's the most important thing. The second thing would be to get central banks out of manipulating interest rates. And so and I have 2 chapters on interest rates in my book. And again, through my book, I'm sort of cutting corners here, but through my book, I go very slowly, step by step. I use, common language. I don't use complicated terminology or anything like that. In part because I can't, but make it very simple. And I use lots of analogies so people will understand what's happening.
That's the goal, is to have people understand the basics without getting so caught up in the jargon. I love that.
Exactly. And so I have 2 chapters on interest rates. One's called natural interest rates. The other is called neutral interest rates. Now, these 2 terms often get conflated in the press or in economics and stuff like that. They're very different things. So a natural interest rate is the interest rate that is determined, as you would expect, naturally by millions of people, all with their own skin in the game, their own capital, making investment and borrowing decisions and lending decisions and risk-assessed decisions. And you put it all in the mix and you get a natural rate of interest. So let's say it's, 5%. And that leads to the most productive economy. That leads to the most efficient allocation of scarce resources in the economy, the wealthiest economy based on the natural rate of interest. What central banks focus on is the neutral rate of interest. Now, central banks and governments have encouraged debt-fueled consumption to drive GDP higher. And when you encourage people and governments themselves take on more and more debt to consume, then the interest payments starts to detract from their ability to spend in the future. So people take on debt. All of a sudden, the economy, GDP is final spending, right? Most of it is consumption. GDP all of a sudden starts to fall a bit. And so central banks say, well, but we need people to take on more debt to fund spending to drive GDP higher. So they lower the neutral interest rate, which is the rate that keeps the economy growing without causing too much inflation. And so they lower the interest rate, people take on more debt, and GDP starts to go up again. But now they can't service any more debt and it flatlines, so they have to lower the neutral rate even further.
It's a vicious cycle, yeah.
And they're all bemused that, oh my God, what's going on? Over the last 20, 30 years, the neutral rate of interest has kept grinding lower. And then, some of them will say, well, it's all because of secular global stagnation. No, it's because there's more and more debt being taken on and people are able to spend less. So you have to take it all the way down to zero. And the problem is, if the natural rate is up here, and this is what results in the most efficient allocation of capital, the further you take the neutral rate away from the best rate, the less efficient the economy becomes. And that's exactly what you were seeing. And Ludwig von Mises, who's like the king of the Austrian School of Economics, he had a saying that when something like this said, policymakers can deny you the right to receive the natural rate of interest by driving interest rates lower than the natural rate, but they cannot eliminate its existence. they cannot eliminate the fact that the natural rate is the one that results in the most productive capacity of the economy. And and so they just, wash, rinse, repeat, whatever. And I think they're starting to see that there's no way out of this.
I think that's most people's fear too. And go ahead.
No, go ahead.
I was just gonna say, I mean, for me, just listening to say that previous part there, when the words come out of your mouth or anybody's mouth, well, we need to increase the debt in order to service, things. It's like that logically, my brain goes, no, I don't. Getting out of debt is the goal, because the more debt you have, the less money you have to invest and grow your money. And I talk to people all the time that say that recommend to people that are looking at starting to invest that if you're in debt, if you got a bunch of credit cards, if you have all the stuff, you got to get out of that first. It doesn't make any sense, because you all that money you're throwing at some company because of compounding interest, you could be growing that money in your investments, regardless of what happens with the market. I mean, you know what I mean? It's very logical to me, and I would think that it would be logical to most people. So,
and if you have debt and you're thinking of investing, you have to compare the interest rate on your debt with the after-tax rate of return on your
APRs for all your. Absolutely, yeah. So, man, that's. I think that's a tough pill for people to swallow too. Is like, even though we are learning, we're understanding, we're getting these concepts into our heads. You said it yourself that unfortunately we're probably just going to have to go through some hurt in order to learn how to get out of this. Like, do you see? I mean, I hate getting all. I know my audience says I go too doom and gloom with some of my theories sometimes, but is there, in your opinion? Before I ask you this question, I'll preface it by saying I remember Alan Greenspan telling Congress a long time ago that the United States will never default because we can tax, there's all these factors that led him to believe that the United States will never default on its debt. But then you look at countries like Venezuela and I think Sudan and Africa. I can't remember exactly what countries who the policies led to hyperinflation and real tough times for the people. And I know Javier Milei in Argentina right now allegedly is implementing more market first, libertarian, for lack of a better word, policies, and apparently it's doing great things down there. So what would you say to some crazy conspiracy theorist that says, if we keep going in this direction, what is the real risk of America, the big guy, the superpower, defaulting and this unsustainable $36 trillion debt finally reaching the end of the railroad tracks? Is that a possibility in your opinion?
Well, yes, and it depends on your definition of default. So I doubt that the U.S. would, let's say to all the foreign holders of treasury bonds that, okay, we're only going to pay you 50 cents on the dollar, but they would default just as effectively by my earlier example, doubling the money supply. And so they pay the bonds back at 100 cents on the dollar. But just like when you had your $10,000 in the bank account, it only had 5 bikes instead of 10.
Sure.
So they'll pay back those treasury bonds, but they'll only be worth half as much as what they were when the other countries initially lent to the U.S. So that's the way you do it. But people aren't stupid. They don't know what's going on. And this is why you're seeing longer term interest rates stay high and could soar significantly if the rest of the world says, okay, no, that's it. Because they're afraid of being financially repressed, and they should be, because there's no easy way out of this. And so again, that's not a conspiracy. I mean, lots of people are recommending that the U.S. do exactly that, and that this is definitely what's coming, financial repression. But what bugs me is that they talk about this as, this is just financial repression. It's just in our toolkit. Okay, we'll do this time. That inflicts so much harm and pain on so many people. And it all comes down to the fact that we are living beyond our means.
100%.
And it's not the world in total, because it's impossible, unless we're born from aliens or something. But within this society and from one generation to the next. And like, if I make 4 times on my home, I'm living at the expense of the next generation.
Yeah. Yeah, that makes sense.
It's a class struggle, and it's creating anger. And this is the first time probably in modern history that the next generation is not going to be better off than the one that preceded it.
Yeah.
And to me, this is like a huge moral issue. And, I know what's going on. You know what's going on. But a lot of people don't.
Sure.
They know that they're getting wealthier my age, but they haven't connected the dots to see that it's coming at their expense. Like, to your point, well, stop going to Starbucks and blah, blah. You know what I mean?
Yeah.
Then it's got nothing to do with it.
Right.
And people do start going to Starbucks more probably because it's hopeless. They've given up hope. Well, I might as well spend my money, I totally get it.
Yeah.
And, and then it's, just this anger. And the risk is that because people are misdiagnosing the patient, like what's wrong.
Yeah.
The risk is that they prescribe the wrong medicine, and then they throw out the free market capitalist baby with the crony capitalism, something for nothing bathwater.
Yeah.
And
absolutely, especially on the left, very common.
Oh yeah, and I totally understand why they're so angry.
Sure.
And and I've talked to some of those people too.
Misdiagnosing is such a great way to describe that. I love that you said that. Use that term. Yeah.
Yeah, that's what I think, and so that's why I'm trying to, educate people with respect to what really are the issues.
Yeah.
And so my house went up 4 times in value. In real terms, it's up 2.5 times if you adjust for inflation. I would be more than happy to see the price of my house go back down to what we paid for it in real terms, because then that would mean the next generation's got a chance.
Yeah.
And I haven't taken out of the system more than I put in. Now, I have 3 daughters. I mean, anything we make on our home will go to them.
Sure.
But if my home price goes down, I won't need to give them as much money because they'll be able to afford a home.
Right. That's a good point.
That's the way it's supposed to work. And a lot of young people, they don't have either parents who own a home, because not everybody owns a home and got all this free money. They think it's free, right? Always comes with something that's expense. Or their parents did own one, but they're relying on that for their retirement. Mm-hmm. And, when I talk to people about this, my age, most of them get it, like right away. They understand. And it's a bit of a shock to them, and they might not necessarily like hearing it because they like thinking, well, I've done pretty good. I bought my real estate at the right time and good for you. And no, you just got lucky because you were older. That's it. Mm-hmm. And, but every now and then, I run into somebody who doesn't like it, and they don't want to hear it. They don't want to understand it. And I use in my book the quote by Upton Sinclair. He was a socialist back in the 30s. And he said that if someone's income depends on them not understanding something, don't expect them to understand it.
Yeah.
They are not going to. They refuse to. And then, they don't necessarily. Actually, a couple have gotten angry at me.
Really?
Yeah. I mean, very few, but they just don't like hearing, in my mind, the truth.
Yeah, the truth is a very tough pill for a lot of people to swallow,
Exactly.
and my audience knows I talk about it all the time. That's exactly what my goal is here on the show, is to present uncomfortable truths in a way that, I mean, more voices need to be out there talking about this stuff. So I have respect for anybody that is honestly trying to educate others in a world where instant gratification and social media and dopamine hits every 2 seconds is just taking people's attention span away from them. And like you said, like home ownership, in my opinion, is basically a requirement for the building of families, strong families and strong communities. And if you can't afford a home and you're apartment living by force, basically, because you have no other options, very difficult to sell the need for starting a family to a lot of people that are in that position. And, people go down the road of conspiracy all the time saying, well, maybe it's by design, maybe that's what they want. And I like talking with people like you that say, well, no, it's not necessarily a conspiracy. It's never, what's that quote? Never attribute to malice what can be attributed to stupidity, or just not knowing, even all the way up to politicians. A lot of people just don't know and don't have that education. So I think you're right. I think that educating people to the best of our ability, whether or not they want to listen to it, is going to be helpful, because at some point someone's going to say to themselves, you know what, maybe I should listen to these people that have, out of the kindness of their heart, given some time out of their lives to share some of their knowledge and experience with us. And I think more people need to be doing it. So,
thank you. And, I think it was good intentions, best laid plans. And, but then the consequences are so severe. And like already where we are, the consequences are huge.
Absolutely.
And it's going to get worse unless we change. But it's very hard for any of us to admit that we had something to do with that.
Oh, right?
Yeah.
100%.
And the book it's not a book about retribution. I've been angry at central bankers for years, and I try to give them an out in the book, but again, they're not bad people,
Well, let's just save face a little bit, but you got to own what you did too. Yeah.
Well, no, true. And, Paul Volcker, who was the Fed chair from, I think it was 79 to 87 or something, legendary. And and then Ben Bernanke, who, much of where we got to today, you could lay at his feet.
Sure
he thought he was smart enough to figure it all out, and that eventually the benefits would trickle down to everybody else and trickle down to the next generation. It hasn't worked out.
Yeah.
And, I don't know people like that you could ever get on board, but maybe I'd be open to.
I've always had a tough time with him when I've heard him speak. And like you said, it's like people need to understand, and this is just my opinion, is that anytime you do a Reaganomics type of trickle down, big tax cut, all that kind of stuff, I can even liken this to the PPP loans during COVID. It's like anytime the government decides to give free money out to a lot of people, the tendency is for the wealthiest to find ways to keep the majority for themselves. And to your point, that's not only misdiagnosing, but that's presenting an incorrect remedy when strengthening the lot in life or the ability to create their own higher standard of living for those lower class people is the way. Strengthening the middle class is the way, because 100%. So I like that you and I are clearly in agreement on that. Is like anytime, and this I've always felt this way, is like, human nature, in my opinion, dictates that anytime, like you said, anytime someone gives you free money, you're not going to ask how it happened. You're just going to take it. You're going to say, thank you very much. And that's what a lot of people did with COVID. So,
100%. I don't blame people for taking it.
Yeah. Especially if you were in need. Why wouldn't you? Yeah, absolutely.
Even if you weren't in need, why wouldn't you take it?
Yeah. I mean, you're absolutely right. And then another thing with that makes me just irks me still, speaking of COVID and PPP loans, is what they shut all the small business entrepreneurs down and kept the big box stores who were already unbelievably wealthy open. And you effectively, like you said, you took that competition right off the table, and these people just made out like bandits during that time on top of all the free money. So anybody that says that didn't have an effect on the state of our economy now, I think is lying to themselves. Like that was an incorrect, playing out of events from the governmental level during COVID. I mean, what do you think about that? Am I completely off by saying that?
I mean, during COVID, the stupid thing that they did, the stupidest thing, I think, so they shut the economy. That was a big move.
Yeah, real big.
Big
Real
move.
big. Unprecedented.
Yeah. Now, at the time, it was very scary. And as you just said, it was unprecedented. And there's probably a lot of panic involved. And so I believe that they thought they were doing the right thing, like to protect the most amount of people. I remember when I was going out, now maybe they unnecessarily scared us, but go to the grocery store and I come back and I wash my hands 4 or 5 times,
Yeah.
I was worried, and based on the news that I was getting and I was seeing. And so I give them a pass for temporarily at least shutting down the economy. And I'm not saying it was the right thing to do, but I can see maybe where they were.
Given the circumstances, it's not a completely malicious intent.
I don't think so.
Yeah.
And if they didn't, and then 50 million people died,
Yeah. What was the alternative? That's a good point. Yeah.
Yeah. So not to say that would happen, but if it did, that's your legacy.
Sure.
And but shutting the economy down, and then sending people trillions of dollars to go spending and shopping in an economy that's shut down was just stupid.
Yeah.
Of course, you're going to get inflation.
Yeah.
That's
a good point.
And these checks, and they call them stimulus checks. There should be no such thing as stimulus checks.
No, yeah.
There should be unemployment checks, welfare checks, green stamps, or whatever they call them now, to help people in need, to help people who are out of work, temporarily help these people get on. Not to give people a whole bunch of money and go spend like crazy and try and drive the economy higher when you've just shut it down.
Yeah.
It
reminds me, I don't know why this keeps popping into my head, but I remember Noam Chomsky saying one time that he was criticizing Republicans, and he was saying, I don't know why these Republicans are so worried about the social safety net and Social Security. There's no problem with Social Security because it's paid for, the entitlements are paid for out of payroll tax. And so long as we don't spend out of that, then everything will be fine. Well, that, to your point earlier in the show, they started spending out of the payroll, out of the Social Security account. That's that safety net. So it's a lot of misguided action that I feel like causes more problems than it solves a lot of the time. And I feel like a lot of that is why we are in the situation that we're in.
Yeah, I think it was Frederick Bastiat, French economist in the 1800s. He said that, I think it was him. It might have been Hazlitt, but he said a good economist looks at like we were talking earlier, the second and third order effects of decision-making. And a bad economist just thinks of the immediate effect and ignores what happens afterwards. Sure. Right. And so, mailing these checks out to people and whatnot. And again, there's nothing wrong. And there's a lot good with sending out checks to people who need it. But if you're sending checks, you're sending more out than people have contributed, and you're taking on more and more debt, then the cost of that is going to fall on other people, primarily the next generation. And, especially when the next generation is very young, they don't have a voice. They don't have any say in the matter.
Yeah. Or any understanding of how we got in this position. Like you said, a lot of people are just giving up right away. It's a pretty disheartening reality, I think, for people coming out of their education and maybe going into college or the workforce. I always tell the young generation, I'm like, if you want to dig yourself out of it, I'm like, go and get into a trade right now. There is the biggest need for trade jobs in this country than ever before, and it's 6 figures immediately out of school, basically within your first year. There's been no better time to be a tradesperson, and I think that I remember just brief. We're running short on time. We got to get out of here soon, but I'll share this quick story. I used to bartend out at the airport here in Minneapolis, and I used to have a guy come in every so often. I found out after talking to him one day that he was a big oil head honcho that they were doing the fracking up in Williston, North Dakota. He was flying back and forth, and dealing with the situation up there. And one day he's sitting at my bar and he says, yeah, I feel bad because I'm getting ready to go lay off about 300-400 people because they were pulling it at the time that they were going to stop fracking. And I said to him, why is that? What's going on? He said, well, politics and money, and people are worried about the environment up there, and it's just it's a tough thing. And he was basically saying that in order to build infrastructure around that city when the boom was happening, when bars were trying to open up out there because all these guys had all this money, and he said that they had to contract tradespeople from Canada to come down across the border to do some of the work because they could not find American companies in enough of expertise or enough manpower to do those jobs. And it just absolutely blew me away that,
wow.
I mean, we had to go outside of the United States to get tradespeople to work up there in that region. And I was just like, if there's any indication that the demand for tradespeople is so large, it's almost a no-brainer for these young kids to start doing those jobs.
Yeah.
And I hope more people start talking about that, because my generation was sold the lie, and whoever the PR person that pushed this is, I will hire them for any of my companies ever, is that you need to go to a 4-year college and get a liberal arts degree and you're going to be fine.
Yeah.
And how many people are in a boat now where they're paying that debt off and they don't even have a job that's helping them pay that? So
Yeah,
anyway,
no, it's not a good situation. Yeah, the trades were looked down upon for many years.
Yeah.
And unfortunately, well, hopefully that's changing.
Yeah, we'll see. We'll see what happens. Before we leave, let me bring in your book here. I want to show people. Here we go, Capital Offence. So there's Paul's book. Go pick that up, read that. And before we get out of here, if you'd like people to reach out to you and get in touch with you, how can people do that?
Yeah, thanks, Andrew. So I have a website where you can access my free blog. It comes out once a week. And so the website is called Paddington Capital MGMT.com. So MGMT is short for management. And I've got all my past blogs up there, podcast interviews and stuff like that, book summary. And so you can just put your email in there, and that's all you have to do. Put your email in and you get absolutely free. You get the weekly email, and people can reach out to me if they have any questions. And then I'm on social media, Paddington Cap. So LinkedIn or Instagram or Facebook and X. So yeah.
Perfect. All right. Well, hey, thank you so much, Paul Musson. Go check out his blog. Go check out his book, people. Wealth of information. And like we talked about today, I hope you guys enjoyed this episode. Educating people about what the heck is going on with money and inflation, and the price tags everywhere it's got people up in arms, and I hope in some small way conversations like these are helping people understand what's going on and helping them maybe make their own decisions for how to hedge and how to get around some of these issues, given the fact that the inevitable future may be by force tightening up your bootstraps a little bit and trying to save and make your dollar go a little bit farther than it normally would. So, Paul, thanks so much for joining us today. And that's the show, everybody. Thanks for watching. Thanks for listening. We'll see you next time.
Thank you, Andrew.
This has been episode 236 of the Politics and Punk Rock Podcast, entitled Capital Offence with Paul Musson. Yeah, Nixon says he was anti-elitist, but he was really an elitist through and through. Take a listen to this. We'll see you next time.
They called it the Nixon shock, and it flipped the global economy overnight. In 1971, President Nixon made a decision that broke a promise the U.S. had made to the world. He cut the dollar's ties to gold. Why? Inflation was rising, gold was fleeing the country, and the U.S. was running out of options. But what if I told you this move didn't just solve a crisis? It created a whole new economic era. The end of the gold standard wasn't just about money, it was about power, trust, and control. And the consequences, we're still living with them today. What really forced Nixon's hand and who benefited most from the fallout? Watch the full story on the Academy of Political Economy.